Hey everyone, and welcome to today's Explainer. I am so thrilled you're here with us, because today we're taking something that honestly feels incredibly overwhelming to a lot of people, business planning and financial projections, and we're gonna make it entirely manageable. We're actually going to approach building your business exactly like building a house. Think about it. You wouldn't just start throwing up drywall without a blueprint, or pouring concrete without digging a foundation, right? Well, the exact same goes for your business. We're going to start right from the ground up. We'll establish a rock-solid foundation, map out the architecture, and do the structural math that ensures your business stands the test of time.
Now, this is really the million-dollar question, isn't it? How do you prove your business idea will actually work? You might have all the passion in the world. You might literally have the most innovative idea of the entire decade. But here's the thing. Passion alone isn't going to satisfy lenders, it's not going to convince investors, and maybe most importantly, it absolutely isn't going to protect your own personal savings and assets. To actually prove your idea works, you have to translate that raw passion into a structured, documentable reality.
Okay, let's dive into this. Here's the roadmap we're using today to turn all that dense regulatory and accounting jargon into a highly actionable plan. We'll hit 1. Building your business foundation, 2. Picking a business structure, 3. Defining your business model, 4. The 4 financial statements, 5. Forecasting revenue and costs, and 6. Preparing for your lenders. Let's get to work.
Starting us off with Section 1, Building Your Business Foundation, or laying the groundwork for your success.
This is where our overarching blueprint to reality analogy really takes shape for us. Think about it like this. Before you can even start calculating the costs of the materials to build your house, you have to legally protect the actual property you're building on. In the business world, your foundation is your legal structure. Your blueprint, that's your business model, the plan of what goes exactly where. And the math, well, those are your financial projections. If you skip the foundation, literally everything built on top of it is at risk.
Moving right along to Section 2, Picking a business structure, choosing your legal foundation.
Choosing this structure is absolutely vital because it influences everything from your day-to-day operations to your taxes and, critically, how much of your personal assets are at risk if things go wrong. And this brilliantly illustrates the whole landscape of options you have, straight from the Small Business Administration. Now, what's really interesting here is how it demystifies liability. Look at the top row there, a sole proprietorship. It's super easy to start, but you have unlimited personal liability. If the business gets sued, your personal bank account or even your house could be on the line. But if you look down at the LLC, the limited liability company, you'll see that owners are generally not personally liable. It gives you this crucial layer of protection, acting like a shield between your business debts and your personal wealth.
Now, for those of you looking to scale up, you might be considering a corporation, but you have to be super careful about taxes here. A traditional C Corp faces what's known as double taxation. That means the corporation's profits are taxed, and then when shareholders get paid their dividends, those are taxed again on their personal returns. Ouch, right? However, if you meet the IRS eligibility requirements, you can choose an S Corp structure instead. This offers pass-through taxation, meaning the profits and losses bypass the corporate tax rate entirely and pass right through to the owner's personal income. It's a massive financial nuance that can save you significant money down the road.
On to Section 3, Defining Your Business Model. Time to start drafting that architectural blueprint. Okay, so with the legal foundation poured and setting, we need to figure out exactly what you'll be selling and who your customers actually are. It is officially time to get organized. Look, a business model is simply the documented plan for how your business is going to generate revenue. Before you can convince anyone else that your business makes financial sense, you need to be able to confidently answer the basics. What specific problem are you solving? Who exactly are you selling to? And how are you going to deliver that value to them? And remember, there is absolutely no single right way to make money. You might use a traditional retail model, or maybe a subscription model. You could even use a razor blade model, where the base product is cheap but the refills are where you make your margin. I mean, we all know the pain of buying printer ink cartridges, right? Or maybe you're building an app and using a freemium model, where the basic service is totally free but those premium features are going to cost money. Whether it's fee-for-service, a franchise, or leasing, your chosen model dictates exactly what your revenue streams will look like.
Which brings us to Section 4, the 4 financial statements, the structural math of your house.
These 4 standard documents are what actually prove to you and your stakeholders that the house you are building won't just collapse under pressure. First up is the profit and loss statement, often called an income statement. This shows how much revenue was earned over a defined period of time, and the expenses associated with earning that revenue. Basically, think of the P&L as the ongoing operational scoreboard for your business. It tells you point blank if you are actually making money day to day.
Next up, we have the balance sheet. So the crucial point here is that unlike the P&L, which covers a span of time, the balance sheet is a static snapshot. It shows exactly what the company is worth at one specific frozen point in time. It basically totals up what you own, your assets, what you owe, your liabilities, and what is left over, which is your owner's equity. Third is the cash flow statement. And listen, profit does not equal cash in the bank. This statement tracks the actual physical movement of cash in and out of your business from operations, investments, and financing. This is absolutely vital because it helps business owners plan for times when they might have lower cash reserves, keeping you from missing payroll even if you are technically profitable on paper.
And finally, the sources and uses of funds. While the other three are kind of ongoing life-of-the-business documents, this statement is uniquely focused on a specific project or event, like starting the business itself or maybe buying a new facility. It shows exactly what the project costs and exactly where the money to pay for it is coming from. Lenders rely heavily on this one to understand how you plan to spend their loan proceeds.
Moving into Section 5, Forecasting Revenue and Costs. Calculating the cost of materials and labor.
So, financial projections typically cover a 3-year time horizon, based on heavily researched, reasoned assumptions. But to actually forecast that revenue, you have to start at the micro level by defining your unit of sale. You have to ask yourself, what exactly is my customer exchanging their money for? Are they buying a single physical product, a monthly software bundle, an hour of my consulting time? You really have to clarify your specific revenue streams so you can start attaching real trackable numbers to your ideas.
Let's walk through a quick example of calculating the cost of goods sold, or COGS, for a product-based business so the math feels entirely manageable. Let's say your unit of sale is a knit hat and your unit selling price is $10. You calculate that the yarn and materials cost you $5 to produce that one hat. To find your COGS percentage, you just divide the cost by the selling price. 5 divided by 10 is 50%. Boom! Half of your revenue for that item immediately goes just to making it.
Now let's move to and see how this builds for a service-based business, because it's a bit different. Say your service is house cleaning, and you charge $150 per house. Your costs here aren't just cleaning spray, it's mostly labor. If you pay an employee for 3.5 hours of work, plus the cost of supplies, and that totals $100, your COGS percentage is 100 divided by 150, which comes out to 67%. So service businesses calculate COGS based heavily on the direct labor and materials tied to that specific job.
And finally, Section 6, Preparing for your lenders. Passing a home inspection.
Okay, so if you've built your foundation, drafted your blueprint, and done the structural math, it is time to pass the home inspection. This is where all your internal planning finally faces the scrutiny of outside stakeholders. All the research, the cost analysis, the market sizing, it all needs to be packaged cleanly. But the digital tools and presentations you use to display these numbers depend entirely on exactly who you're asking for money. You wouldn't hand a hammer to someone who needs a screwdriver, right?
So here is exactly what tool goes to what stakeholder. Traditional lenders, like your local banks or credit unions, are highly focused on historical industry data and your ability to repay a loan. They want to see detailed traditional business plans and robust financial projections. On the flip side, investors, like venture capitalists or angel investors, are totally focused on rapidly scaling startups. They're going to want to see pitch decks and business model canvases that highlight massive growth potential right alongside those financial projections.
I absolutely love this quote from the source material because it perfectly summarizes the whole goal here. The documents show lenders and investors how you will repay any loans, what you intend to do with your money, and how your business will grow. But please remember this, even if you never seek a single dime of outside funding, completing this projection process massively increases your own confidence. It allows you, the owner, to make educated, proactive financial decisions instead of just guessing.
And that brings us to the end of our blueprint. You now know the legal structures, you understand the 4 financial statements, and you know how to calculate your direct costs. The plans are officially drawn. So, I'll leave you with this final thought. What is the very first brick you're going to lay for your business today? Are you going to formalize that LLC? Or maybe finally sit down and calculate your cost of goods sold? The tools are completely in your hands. Thank you so much for joining me on this explainer. Stay focused and keep building.